Well, good morning, ladies and gentlemen. A very warm welcome to our annual press conference here in Frankfurt. We are delighted you accepted our invitation. Our board members, Tom Blades, Christina Johansson, and Duncan Hall, will now present you with the preliminary figures for the financial year 2019. They're going to give you a forecast and explain the strategy. And after the presentation, we'll be happy to take your questions. Before we start, I would like to point out what is necessary in case of an emergency. Please leave the room through the emergency doors. Follow the green signs that mark all the escape routes. Please always use the stairs to leave the building, and please go to the place into the center in the lobby where you can where everybody can assemble. Now, Tom Blades is going to give you an overview of the financial year 2019. Welcome to everybody. Hello. Now, this is us once again. As Mr. Stopfer already said, I will now give you a brief outline, and I will pass on to my colleague, Mrs. Johansson, who's going to dig a little deeper when it comes to the figures. I think you're familiar with the headlines already. This is what was contained in our press release this morning, and I think we might say we did it. We did completely fulfill the expectations for 2019. Our revenue has increased by 6% organically. That means adjusted for currency effects and similar effects. And I'm particularly delighted to tell you this because we had already achieved 6% in the previous year, so we are continuing on the growth track. Our EBITDA has risen by 65% organically to 104 million euros. This is also where our forecast of increasing to significantly more than 100 million, this has also been fulfilled, and we can make a check mark behind it. And our group result it was very positive. We even exceeded the break even by at 24 million. Before that, it was in the minus, and this year we have the first year in the plus, and it's the first time we have a positive group result since 2016. And as you might know, 2016 was also the year when we sold up Leona, so it is all the more important we actually made our operating result. We achieved it. And most importantly, the operating free cash flow, as I reported, we said that for 2018 we would have an adjusted, corrected, positive cash flow, which we actually achieved. And this is also what we can report this year. So this is another step forward and another check mark we can apply. Now let's move on to a lower level, order intake, orders received. That was flat. And we already told you why. There was a slightly decreasing effect with 4% from the high level we had achieved in 2018. We didn't expect that. We thought it would be a little higher than that. But we already told you that this is clearly due to the fact because some large-scale projects were shifted. So they were not cancelled, but they were just shifted. So actually our markets are intact and stable. And as I already told you, our turnover in the fourth quarter, also compared to the fourth quarter in 2018, there's a slight downward trend, but that doesn't worry us because we know that the orders are about to come in, and this is going to continue in the year 2022. Now, the adjusted EBITDA at 104 million is at a level of 2.4%. So the big issue, of course, and this is also where we can present our strategies, is how fast will we be able to reach 5% or more than 5%, but we have made it halfway, and I think after the last year it's a great progress we can report, and this is really the merit of our teams all over the world, and we are very satisfied with this. As I said, the group result is positive at 24. There was a turbo sprint at the end of the year in the fourth quarter, similarly to the last quarter of the previous year. And of course, it's always somewhat thrilling, and it's always it demands a lot of us. But we did keep our forecast, and we achieved our results. Now, regarding our liquidity, our cash, it's positive, 57 millions, and this is also something that is really due to the fabulous performance of our teams everywhere in the world. Our DSO and now the outstanding invoices, we have reduced that time by 10 days, which is a huge step, especially towards the end of the year where all the customers really watch their money. So that's a great performance of our teams that also made it possible for us to really achieve our year-end goal. Now, regarding the balance sheet and the dividend, we have a solid balance sheet, and you've also seen that in the year 2019, we refinanced our bond. We paid back the 500 millions, so maybe we have become even a bit more solid, and that is also the reason why we will propose to the supervisory board and the annual meeting to keep the €1 dividend. And lastly, we had already told you that in Q3, our outlook for 2020 has not changed. Our revenue development will remain stable, flat, maybe slightly upwards, but mostly stable. And we will also be able to continue to increase our EBITDA. This is a continuous process. As I said, we are envisioning 5. This is our target figure. I will tell you more about that later on. And we will also see a clear increase in the reported cash flow. We will also be able to demonstrate that to you. Now, that much on the headlines. And with this, I would like to hand over to Mrs. Johansson, who's going to dig a little deeper for us. Thank you very much. Well, also from my part, a very warm welcome to all of you. I'm very glad to be able to explain the figures in a bit more detail to you. As Mr. Blades already said, we have achieved the financial goals we had set for ourselves for 2019. And now this is the second year in a row where we kept our promise, which is the be-all and end-all of everything. We want to make promises and really keep them. So for 2018, we did the guidance, and we will also be able to confirm it. Now let's start out with orders received. Here we can clearly say that we were not satisfied with how we finished this year, but now we have gone 6 years into the new year, and quite a lot of movement has taken place in the order books, and some of those major projects that we had expected to come in 2019 have now actually been confirmed in the first quarter. So here we have a figure of 4.159 million in orders received, which is 4% less than the previous year, where we had a very strong order intake. Yes, it is a deterioration due to some major projects which were postponed, and in our announcement for quarter one, some of these large-scale projects will actually be manifest. Now, there are no negative news, just a shift. Book-to-bill has been completed with 1.0, and our order backlog at the end of 2019 amounts to 2.567 millions, which is about 7% billions, which is about 7% less than the previous year. And we believe that in the first quarter we will be doing well, and we will be able to catch up with what had not been materialized in the fourth quarter. Now, regarding this large-scale projects we had expected for 2019 and which were shifted, now in January we have a larger project in the lower 3-digit million area with BP subsidiary Oil, where Bilfinger was commissioned to have pipes and installed in a refinery in Gelsenkirchen, as well as some other engineering work. So especially mainly two Bilfinger subsidiaries of Bilfinger are going to generate a good turnover and also good utilization rate. Now, what has also been an issue for quite a while, and we have time and again confirmed that smaller orders will be commissioned in InQ points, and here we will also see actual order intake in the first quarter. So it's slightly below our expectations, but as I said, this situation will improve in the first quarter. So except for North America, we are doing very, very well. Now let's move on to revenue. Mr. Blades already mentioned that the year 2019 will be completed at 4.327 billion, which corresponds an organic growth of 6% in the second consecutive year. So this is a very strong and positive organic growth we see here. And with regard to the net profit, we have an adjusted EBITDA of 104. It's a margin of 2.4 percentage points. And if we also look at the special effects of the adjustments and deduct them, then we have a reported EBITDA of 32. Now here, just as in the previous year, we have adjustments and special items amounting to 72 million. The largest part of it, is due to restructuring costs and our IT rollout of our common systems. Now, also due to seasonal effects, we have the best result in the fourth quarter at Bilfinger, and this time in the fourth quarter we generated 57 million, which is a very strong fourth quarter for 2019. I have mentioned the special items, and with this I would like to move on to the two most important levers looking forward, because at 104 million and 2.4% we are not satisfied, but we want to continue this transformational journey. And in the third quarter we have already given you the guidance for 2020, and we now have to take a look at further positive steps that we want to achieve at Bilfinger. Now, the first thing is our gross margin, which in the fourth quarter, also due to the fact that we see a very strong utilization rate, but also due to other improvements, we have increased it to 11.3 percentage points. So compared to 10.5 in the last quarter of 2018, this is an increase. In the fourth quarter, but in general for the last year, we see 9.5% compared to 9.4% in the previous year, which represents a slight improvement. And we will also see it in our strategy and the targets for the next 2 years. We want to further increase our gross margin until it reaches 12 percentage points. So there's a lot of work to do. There are a lot of things on our roadmap to move from 2.4% to 4% in 2020 and to 5% that we promised you for 2021. So this is one of the two big levers. The second issue is our overheads, our SG&A ratio. Here we finished the year with a further improvement. In 2019, we have an adjusted result of 8 percentage points compared to 8.7% in the prior year. And if you look at our journey from 2016, you can see a continuous improvement with the program that we had already presented in the second quarter, with further reductions on all levels, on the local level, the divisional level, and at headquarters. Here we are aspiring to a further reduction in 2020, where we'll arrive at 7.5 or 7.6%. And once all of this has been implemented, we will arrive at about 7% in 2021. So these are the two big levers with very detailed plans that have been created, and some of them have already been implemented. For SC&J, we also have to clearly say that the last program already started in the fourth quarter, and it also shows some positive signs. Now let's move on to cash and cash generation. We see a fabulous fourth quarter, as Tom Blades mentioned. We made up for a lot in the last quarter. We collected receivables from our customers, we reduced our stock, and we also made sure that down payments and supplier invoices were sent out earlier. We see the adjusted operational quarter, the quarter on the left on the top, and here we can see a clear improvement compared to the previous year at 227 in the quarter compared to 163 in 2018. For the overall year, it's 181 compared to 110. And of course, it's a combination of an improved financial result, a better EBITDA, but also an improvement in the working capital management. So on the right-hand side, you can see the group result and also a clear improvement. We see 24 million group result compared to minus 24 in the previous year. And if we see the adjusted group result, then we see an improvement of 13 million compared to the previous year. So the key performance indicators are all developing as planned. And even though we are far from being really satisfied with these figures, it's still a good and stable step forward.
So let's now take a look at the forecast for 2020. I think that comes as no surprise. The numbers have already been mentioned in our quarterly reports after Q3. So based on our order backlog, based on the large projects that had been delayed, we are now expecting no increases in terms of revenues, but we do expect to be stable organically. And the next is here adjusted EBITDA and adjusted EBITDA margins. So we do expect an increase to 4% in 2020. And when it comes to the reported free cash flow, we expect a clearly positive development. So at this stage, I would like to turn over again to Mr. Blades. Thank you very much, Mrs. Johansson. Let's go on with the strategy to take us forward. And I would like to start with looking back. So our strategy, Bilfinger 2020-246, it has been named. And it had been adopted in 2017, and it was also in February of that year. And we said that our target is to get to 5% EBITDA, and we wanted to get to this target in 3 phases, in 3 steps. And we were saying the first phase is all about stabilization, the second is about advancing, and the third one is going to be about growth. And then once we got there, once we achieved the financial target that you can see on the right-hand side of the chart, we unfortunately had to say that it seems to be stonier and harder to make progress than we had expected. It's almost like dancing. It's like, 2 steps forward, 1 step back, but then you go on. And then we also figured out in 2019 that it is always going up, consistently. We are moving forward, and also we are getting into the final lane. And also we had introduced the implementation plan back then, and we said that all the numbers that you can see here that are mentioned here under stabilization, so we ticked all the markets, and also in terms of build up, all the milestones. That is really what we subscribe to. It's a lot of smaller steps and smaller progresses, but we can tick all of these boxes now. So we can now truly say that it's now the right time to go on and build out. So the strategy has not changed. So it has been shown that we have embarked on the right path back then, and we're still on the right path, and that is something that we would like to prove to you now and discuss with you now. But what does it mean in the end? It's really about getting to the target. It's really about completely implementing our financial targets. So let's start with a short clip. It's only a couple of minutes to give you an idea of where we are going, and after that I would like to present a couple of details on that.
At a time when elemental changes are happening at breathtaking speed, forward-looking businesses need a reliable partner with fresh ideas. Climate change poses a historic challenge. What's called for today are sustainable concepts that will reduce carbon emissions and foster circular economy systems. At the same time, the average age of industrial plants is rising year after year. Maintenance and the ability to extend the asset's life cycles are becoming more and more vital. Digitalization is profoundly transforming industrial processes. Intelligent, trend-setting solutions and capable partners are urgently needed. But well-trained and skilled people are getting harder to come by. That means outsourcing services beyond the scope of the asset owner's core competencies will become more common. These trends will shape the future of industries across the world, and they are driving Bilfinger's approach to business. Building on decades of experience, Bilfinger constructs, maintains, and modernizes industrial assets across many different regions, all with different requirements. Whether it's extending life cycles, boosting efficiency, or enhancing sustainability, Bilfinger has always been linked to the process industry through long-term contracts and cooperation with its clients in a spirit of trust. Based on this comprehensive expertise, Bilfinger turns data into value by making plants smarter and more transparent. Innovative solutions leverage the full potential of artificial intelligence, augmented reality, or cloud-based system networking, and pave the way to success for asset owners. Bilfinger's people are its most valuable resource. They're not only well-trained, but also committed and highly motivated. Bilfinger's people work to exacting standards using concepts such as BMC or BTC, which guarantee the highest level of quality and safety. These three factors bring the success of Bilfinger's two business lines to life for asset owners. The portfolio of services covers every link in the value chain under one single brand, Bilfinger. That's what makes Bilfinger the perfect partner in helping its clients meet the challenges of the digital age even better. We make it work.
Well, I need to get up and move around. I always find that so inspiring, and sometimes it is also part of me. So I try not to fall down from this little stage. So you've seen the clip, and I think that you've got an understanding of what it is that we are set out to do. And also in the previous year, we had a couple of meetings as a team, not only the board, but also we brought, the important players in from the group, and then we revised what we've been thinking about. Is the strategy right? Have we, picked up on the right trends? And I think the answers have always been yes. And what is important to us is really to take a look at the four global trends, at the four drivers, we call them. It's really about environmental, social, and governance. So I think governance is something that we can totally take off, here for us at Bilfinger. But what we are seeing is that there's more and more pressure on our clients in terms of the environment, in terms of climate change. Maybe you saw this morning that there's Mr. Looney, from BP says that BP wants to be climate neutral by 2050. That is quite something for an oil company. It's a huge challenge, and companies like Bilfinger can contribute to that because we've got the competence to take our customers just there. And we take a look at CO2, but we also take a look at other air pollutants. So that is also SOx and NOx. So it is not only something that we see in ships, it's also something that we see in cement factories and in Gallon. We work with clean energy, and also we work a lot with decentralized energy centers. So power to liquids, that is something that is what everybody is talking about. What does that mean? It's a windmill. It's turning, power is being generated, and that power is then turned into hydrogen using electrolysis. For the chemical industry, it's really about cycles, cycle industries. You use waste, and then you turn that into energy, and also chemical products. And last but not least, we are also noticing that investors, you probably read about that, BlackRock, they are saying to really invest in those places, where it is really about ESG. It's really all about greening your image. That is where he wants you to invest. And also Mrs. von der Leyen and the EU, they come out with the Green Deal. So all of these trends are extremely important to us and also, are very much in our favor. And last but not least, it's really about our clients' plans. That is our daily bread and butter. So these assets are maturing, they're aging, and just as people, they need more TLC. And that is exactly where Bilfinger comes in. So these assets will always be extended in terms of life expectancies. Let's take a look at the platforms in the North Sea. They were built in the 1960s, but they're still up and running. Some have been dismantled, but that is something that has never been expected, once they have been written off, and then you invest again. So that is the moment where they really turn into asset makers and profit makers. And it's really about efficiency and efforts to increase that. The Middle East is still something that we focus on. So we see a lot of things in Europe and in America. That is what we've been talking about so far. In the Middle East, it's about the teenager plants. It's the young people. So these plants have been extremely expensive. So it's high quality. People spend a lot of money to erect these facilities. And so far, problems to do with these assets have always been solved, bringing in more people. It's not that expensive to bring more people in the Middle East. But now we see that situation changing. It's no longer about quantity only. It's also now a lot about quality, and Bilfinger now comes in. So you've read about that. We just were awarded a big job in the Middle East, guys, and that really shows you that what we are good at is something that they need over there. The third item is really digitization. It's really about data. It's really about artificial intelligence. And that is what makes the machines smarter, and that impacts our life. Also, we have a lot of devices that go through learning, so they are being fed by Bilfinger processes, by Bilfinger employees, and that is then information that is retrievable by other Bilfinger employees. So you can basically take advantage of the expertise and experiences of Bilfinger people in the past. So we work with predictive and prescriptive maintenance. It's really about giving customers an option. Things happen, and then you do this and that, and then it's really virtual reality. So that is really the 3D. It is probably also something that you might have on your Xbox at home. Augmented reality is when you put on your glasses, and then on the one hand you have the 3D model, and then you have your real eye, and then you merge these two worlds, and then you can do stuff together. It's really maintenance, it's overhauls and things that you have not been able to do in the past. It's machine learning and things like that. And that really shows you how our world is being connected to the data world. We are talking a lot about OEE. That is really the overall plant efficacy. So it's really about the plant efficacy, and customers are under more and more pressure. It's not only about emissions, but it's also about efficiency. They want to get more out of their plants, and we help them to get there. once you understand your plans better, you can then also evaluate risk differently and assess it. And also digitization is very helpful when it comes to that. And last but not least, you'll see it next year, this year already, that we have more insights, that we have made more progress, that we have the competitive edge in comparison with others, and that allows us to come up with new business models. And then something that is very important here in Germany, but also in America, is really the lack of skilled labor. In Europe, it is really a question of supply. In America, it's more about demand. So here in Europe, we see that more and more places and placements to train more people, remain vacant. People that want to be scaffolder, that want to be welders, plumbers, etc. You talk to your partners, you see where the pressure comes from. And we see the same when it comes to our assets. We really, really have to fight for the best people, and we've been doing that very, very successfully. In America, it's somewhat different. There's enough people out there, but the unemployment rate is coming down, and because of that, there's now an oversupply of jobs, of vacancies, and people are being shifted from Texas to California, and the new employer is going to pay you lots and lots of premiums to come. So we have the same situation but different symptoms. The Middle East has a lot of young people, cheap people, people that are available, but it's really about how to train people, how to retrain people, how to further train people, so to really make them shift, and no longer focus on quantity only, but quality as well. So what is Bilfinger doing? What are our core competencies in order to really take a look at these four topics and to help our customers to go there? I think what is very, very important is our expertise. We've been doing what we're doing for quite some time now, and there's basically two lines. There's engineering, and then there's E&M on the other hand. And these two are really very much complementary. So our engineering know-how has given us a lot of credibility to talk to customers about their plans and their assets. And we have a lot of knowledge about processes. We know what it takes to make these assets run smoothly and even more smoothly. And our customers very much appreciate that, and they are very much interested in a long-term cooperation with Bilfinger. So a couple of customers we've worked with for more than 70 years. So long-term contracts really testify to our concept working out. So it's really the stick rate that is very, very important. That is actually 90%. So we've had very, very few customers that we lost, and even, maybe we lose them because they are actually expanding a larger plant, in other countries, and that is where we will then come in again. And if you want to compare Bilfinger with other companies, you'll see that we're very active in a lot of companies and in a lot of countries. So we can do cross-border. Not everybody can do that. That is very important. So let's say if you want to catch up, if you have an overhaul, and that is planned well in advance, and now the customer is going to turn around in July 2022, I need 600 people plus, but I need that on a construction site in Belgium, and another client is going to tell you I need 1,000 people 1 month later in Austria. We can do this. Not everybody can, but we can. And our competencies, our expertise, really cater to these global drivers. Digitization, so we actually sent up the Bilfinger Digital Next in Heidelberg, and we wanted to have people somewhat apart from our day-to-day activities. These people are hard to find. We wanted to hire 40. Now we are at 45 really, really perfect people. People that are also very much required by Google, by Amazon, whoever. And they want to come to work with us because we are telling them we want to take Bilfinger into the future with you. We want to take the next step, and when we have the Bilfinger maintenance concept, and that was now enriched by a digital offer, which we call BCAP. And because of that, we have now merged these two outlines, and it's now a digital BMC. So also digitalization is what we bring forward, and that is exactly what customers want. But it's not only customers benefiting from that. It's also Bilfinger itself benefiting from that. We are more efficient. We have the electronic workflow process. We use iPads and iPhones. And also we work with augmented reality. So we really take advantage of digitization in order to become more efficient in our own processes without actually reducing prices. So it is really what we do in order to increase margins. We use a lot of artificial intelligence. One example is really pit graph. So you might be aware of the P&D, so it's the big tubes, the big sheets, and then you have the process flow on that, and a lot is still handwritten, and it comes with annotations and manual things, and these big schemes can now be put into a fax machine. It's probably more of a computer, but the computer will now read the whole process and describes the process, and then it turns it into a computer model. So we can also use drawings of plants that are 50 years old, 60 years old, and we can send it through the machine, and we can then come up with a twin. Very few people can do that. We can. And because of that, we are actually a very, very attractive partner also for others. We have rejected, a couple of offers already, but now we are, taking a look at that again, and then now we know whom to launch our digital processes with. And that is also something that we want to foster in 2020.
And lastly, I already talked about the lack of skilled labor. We know that this is also something that drives customer towards us, because they also say, we see that our experts, our workers are growing older. And the question is, do we get enough new people to replace them, or do we rather outsource our work? So this trend, if we use it properly, it might be a very positive one for us. We are the biggest industrial services provider in Europe. We are attractive for young people, be it digital people, but also for plumbers or scaffolders or welders or what have you. Our people are qualified. We have 34,000 employees in 3 regions. And on top of that, we have thousands of temporary workers which we employ in the peak phases in summer, or when there's a special assembly project in the United States or in the Near East. So Bilfinger is really a people company. Now, what are our strategic assumptions, our strategies based on, in order to merge the key competences with the trends we saw? Now, of course, we will first stick to North America, Europe, and the Middle East. Our concept doesn't change there. Our strategy holds, so we can check it off. The industrial focus, the industries I mentioned are not the only ones, but these are the focus ones, and we continue to be very strong here. The first 3, oil, gas, and chemicals, as well as energy, amount to account for 80% of our revenue. And this is where we can grow, where we are experts, and we are recognized, and where customers recognize this. Digitalization, yes, we will also further increase that. Engineering, maintenance, and technologies. People always ask us, why don't you sell technologies? Well, there are several reasons, financial reasons as well as tactical reasons. And from the customer side, we are respected because we master these technological skills. If we didn't have the technology division, we might not get the project, the award. The same is true for industrialization. We won SABIC, for example, in UK in 2019. Our customer said, well, we chose you not because you're cheaper than the others, but because you have a forward-looking vision. You know where you want to get, and this is why we want you to take care of our assets. Well, lack of skilled labor, that's an assumption which is a fact today, and it will continue to be the case in the next 5 years. It might get even more difficult. These are all the assumptions we have to work with. Now, the strategic imperatives, this is what we want to implement in our strategies, the must-dos, the must-haves. The imperative, it's the same in English and in German. The first imperative is compliance. You are familiar with all of that. I don't have to explain it to you. But integrity and HSE, health, safety, and environment, are topics which are where there's no compromise, zero tolerance. I think everybody at Bilfinger knows this. We have very positive results, and they will improve even further, and this is non-negotiable. Our employees, we have to win them, we have to keep them, and we have to further develop them. We also have to not just have this service offer for our customers, but we also have to show that we're innovative. Our Civic example shows that we're on the right track here. We also need to further expand our portfolio with integrated solutions. And last year I talked about portfolio rotation, and that continues to be an issue. So we want to get rid of the weaker projects and instead rather work with higher margin companies and possibly also through further acquisitions and thus expand our portfolio. What's also important is asset light. We have few assets. It's not, we don't have like a car manufacturer, huge plants, but our investment is in human capital. We have few factories, and that's also what you can see in our depreciation rate. Our investments amount to 50 to 60 million per year, which is very low, and we want to keep it that way. So if we think ahead, also when we think in terms of working capital management and M&A and acquisitions, we are going to strive to tie up the least possible capital and reap up as many profits as possible. Now, and the bottom on the left-hand side, when I look back, we have achieved a lot. We achieved almost everything that we had planned to achieve. What is missing is the margin. So we said that we wanted to increase our margin from 2017 to 2020 by 200 basic points, 2%. And you have seen in Mrs. Johansson's figures that quarter by quarter we make progress, but for the overall year we have only increased by 0.1 percentage points, and that's not enough. For that reason, our focus in the coming years is to really implement steps to reach this margin. We are also going to talk about that in more detail this afternoon. We know exactly what we have to do and how we can get there, and we will deliver on what we promised. SG&A, here our costs, we are on a good track. We started with 10.5%, and our objective is to reach 7.5 percentage points. We are going to achieve it this year. We are really on track, and we will improve even further, as Mrs. Johansson told you. And lastly, our region, we are satisfied with where we are. Europe, our biggest market in the United States. We think that there's still further potential, especially in E&M. If we could transfer what we're doing here to there, it would be very good. And the same is true for the Middle East. It's not just about expanding E&M as we did in Abu Dhabi, but even though we are very present, and we have been very present for a long time in the Middle East, 80% of our turnover comes from energy and similar things. For that reason, the oil market, where we've just really gotten started with a project in Saudi Arabia, gas compressor fields, and we are starting to do the same in Kuwait and in Abu Dhabi, and there's a lot in it for us, for our strategy. Now, the questions that are always asked first by our analysts when we meet on a one-on-one basis, they always ask us, what is your perspective of the market? They say, hi, how are you? How is Bilfinger doing? And then, what is your perspective of the market situation? And they always expect us to say, well, pessimistic, it's bad, everything is terrible. And we always disappoint everybody. No, our markets are robust. Our markets are long cycle. We have very long cycles. And at some point, if the world economy was to tip, we would also see it, but at a later point in time. For that reason, we will have time to adjust. What we see today in terms of chemicals and petrochemicals, in the next 5 years, the market is going to grow further. It's going to expand further at about 5.5% CAGR per year. And of course, a lot of that is in the Far East, India, China, with the known challenges we are facing today, but it's a 5-year forecast. So the market is growing, the population is growing, the population wants more chemical products, and for that reason, we are glad to see that this is a market that's still increasing. Now, for our oil companies, customers, it's a similar situation. Many people say, well, the price for oil is $2 to $3 lower than the previous year. Now we have to tighten our belts. No, that's not the case. If you take Total as an example, Total is an important customer of ours in Antwerp. And in the fourth quarter of 2019, they had a cash flow of $7.4 billion. This is 20% more than in the previous year at the same point in time. So even though the oil prices are stagnating or even decreasing, the customers are generating more cash. Why? Because they have a grip on their costs. And this is then invested in their plants to maintain them in order to adhere to the emission criteria and also in order to further enhance productivity. So Bilfinger is helping their customers, not just efficiency-wise, but also when it comes to the requirements from the environment. The number of plants, the number of assets is increasing. They are growing older, as I said, in our core region. So that's basically Europe and the United States. 60% of the overall assets are over 20 years old. So they generate cash if you invest in them because they have been written off already, and they are also of course, it's not, and people might expect that at some point you have a flat line here because they can't get more efficient, but that's not true. In Antwerp, we have customers and Borealis. They have projects also amounting to 2 billion. The market is growing not just due to the fact that the plants are maturing, but also due to new plants. And lastly, climate change. People ask us, customers ask us, Bilfinger, can you help us when it comes to CO2 reduction, when it comes to emissions, but also water purification? We work with these customers. We have a huge customer in the UK, Thames Water, also in the Middle East, where we have desalination plants that we operate. So all of this is really something that we benefit from. As I said, we're number one in Europe, and I will prove it to you. The European market accounts for approximately 25 billion euros per year. UK is number one, not just because I'm British myself, but also because the business in the North Sea is also driving these figures. So the North Sea is still a strong business, not just on the UK side, but also on the Norwegian side. For that reason, you can also see this column for Nordics. In the United Kingdom, we are number two because they're big players in the North Sea. In Germany, we are clearly number one. If you release the Dividend study, Bilfinger is always by far the first. Poland number one, Austria number one, Belgium, Netherlands number two. So if you, Mrs. Johansson is also glad about that, of course. So if you add all of that up, you can see clearly that we are number one. Now, what makes us be number one? Well, we are a people business. Our employees turn us into number one. And if you can see our headcount, 2018, it was 35,900. At the end of 2019, it was 34,900. Why? Well, we sold several businesses. Our biggest sale last year was a service provider in Austria with more than 1,000 employees, which is also reflected in the figures, of course. But there are also positive news. If you divide the revenue by the headcount, you can see that our productivity is going up. And this is also something that we had promised, and it's also part of our margin story. Now, if you look at the region, you can see that we are in a good position, not just in Europe, but also in the Middle East, but also in North America. Now, the growth we had promised and that we have already delivered on in the past 2 years, we promised 5% and we delivered 6% organic growth. Now, looking at the future, we want to achieve a year-on-year growth of 5%. But we said that in 2020 we will rather have a flat growth. Afterwards, it's going to increase again. Why? Well, these are the orders we had expected in 2019 and which will come in 2020, but which will only be lead to increased revenues in 2021. So if we add up all of these figures, and of course all of this involves a lot of work and a lot of detail, you can see that we will continue to grow in Europe by 3%. We will see the biggest growth in America, in the Middle East 7%, and technologies. This is where we need to catch up. We will also see growth, and those large-scale projects that had been shifted are mostly technologies related projects. So for that reason, you will also see that we will achieve a CAGR of 9% on average in the next 5 years to come. On the right-hand side, you can see the same, but now it's broken down by focus industries, energy and supply. This is the anchoring point effect, where the growth figures will go up, but we also see very positive figures everywhere else. And taken all of that together, we see this growth of 5% we have on budget. Now, this afternoon, when we meet with our analysts, these are people who have created Excel spreadsheets on Bilfingers for many years, and they will ask us, how do you plan to increase your margin? Well, we know what we will have to do. As I said, Mrs. Johnson showed that we see a huge leap forward between 2008 and 2019 in the fourth quarter. And we've also presented what our margins will look like in the next years and in the year. And it looks a bit complicated at first glance, but it isn't really. Down here, you see a list of our main services we offer in this industrial services, maintenance, repair and maintenance, accompanied by engineering, which has the highest margins. Now, this dotted line is our target margin. We said it should be 12% or more gross revenue margin. Now, we have already achieved it here. We have exceeded the target line. For maintenance, we are on the target line, and also when it comes to multi-services and building and assembly, we are slightly below. But altogether, all of this is above 12%, and they account for 85% of our revenues. So we have already 17/20 parts on the finishing line. So these are the only items which are still somewhat difficult here. This is where we want to get in 2020. In 2019, we're slightly below here, where you see in the dotted line, below the dotted line, as you can see here. So we have to be careful that the poor execution of the business here is repeated. On the upper end, there's little difference compared to the previous year. But we need to avoid the outliers. It's about execution. It's about rigorous planning and implementation. There are very specific and detailed steps that will enable us to do that. The second box is supporting systems. These are areas where we said last year that even though they're doing well, there are companies that will remain far below our margin. We have improved them. They used to be down here. They are up here now, and in 2020 they will have increased even further. So we believe that we might be able to sell them. If we do that, if we can do that, we will take the money to buy stronger companies, and this will enable this portfolio rotation that we address. So this is what we plan to do. I talked about our strategy to us, what the drivers are, our imperatives, how turnover, how revenue is going to increase, how the margin is going to improve. And in order to get deeper into the details, I'd like to hand over to Mrs. Johansson, and then I would like to sum up everything that had been said.
Well, Mr. Blades has very much covered our core markets, oil and gas, chemicals and petrochemicals, energy and supply. What will these markets be like in the future? What challenges do they hold? And also he has outlined what we've got to offer to our customers to make sure that they get what they need to solve their problems. So we're very, very optimistic. We're very confident for the year to come to be able to increase our numbers for the revenues. It always makes me laugh. I'm Swiss, and I'm commuting between Germany and Switzerland. And there's one thing that I would like to see more of in Germany is like to not be so negative. It's like also, there were the Brexit discussions, and then for a couple of times I said, well, even the English are more optimistic than the Germans. And I think, our board team, it's not like two English, one Swiss, but, we really, really do not see the restrictions of our markets. And as Mr. Blade said, we are not the first ones to see it and view it that way. It's really about always creating new opportunities. It's really about developing a company. It's really about having a long-term strategy to figure out what is it that our customers will need, not only tomorrow, but also the day after tomorrow, and what is it that we've got to offer them to solve their problems. So I would want us to be more optimistic, more confident when it is about the future, and that is definitely what we do here at Bilfinger. We also heard a lot about what still can be improved. Me as the CFO find transparency and honesty extremely important. So we are not perfect when it comes to doing things. We do them at Bilfinger. So we've just improved. We do a lot of things a lot better than we did in the past. And also in 2019, we've been able to show that there is one segment, technologies, that did not go as well as we had hoped, expected, and planned. But we've also been able to show that Bilfinger is strong enough, is sound enough in order to mitigate that effect and still take the group forward as a whole and still keep our word. That is strength, and it's also about a lot of transparency and honesty. And now we're looking forward to take a look at those things that have not yet played out perfectly. And now we're going to take the next step in the next 2 years here at Bilfinger in order to make sure that we will still profit from our strength in the future, and we will also make sure that we make fewer mistakes. So where are we going to get with all that transparency? And this is where you see the development. So there's the planning cycles. It's, of course, 2020. So we, of course, plan in great detail, but then we also see 2021, 2024, and that is what gets a rough planning at this stage. So revenue developments. I mentioned already that in 2020 we expect a flat revenue development, but after that we expect an increase of 5% organic every year. And then if you then do your calculations, then in 2024 we get at something like 5 billion organic turnover. On the EBITDA side, we have the 104, the 2.4% in 2019. That is the results that we had. So for 2020, we wanted to arrive at 4%, and then let's take it from there. In 2021, it's going to be 5%, and until 2024, we expect organic growth to take us to an EBITDA of more than 250 million. So that would be more than 5%. And also, you'll notice that we stop, and it's about time we did that, to take a look at this adjusted EBITDA and reported EBITDA. So it's just going to be one EBITDA. So it is about internal transformations. Of course, there are special effects. That is also something that Bilfinger has been able to show in the past. There's restructuring costs, but it also comes with an improved IT support system. So in 2020, we'll see a reduced amount, which mostly is due to the SAP rollout, which is to be continued, and I'll come back to that in a minute. But also it's going to be a lot less. So we had 72 in 18, 72 in 19, and there's going to be a smaller amount in 2020. And in Q1 2021, we'll have the last quarter that will see adjustments or special effects for that. After that, there should be just one EBITDA, and that should also have completed the transformational process. Free cash flow. So there is an improved EBITDA with fewer special effects because of restructuring, but there's also going to be a more efficient working capital management. And also because of that, for 2024, we expect a free cash flow of more than 200 million. And that, of course, is very attractive. So these are funds that we can then use from within the company to further develop Bilfinger. Let's take a look at the two levers that I had already mentioned in 2019 and 20. So this shows you the development that is the adjusted gross margin. So we close with a 9.5% in 2019, and there's a plan that comes with measures to take us further down the road, 2021-24, and we want to get to 12%. Up to 2024, we should be above 12%. So that is what our ambitious challenge is. That is what we commit to. And how are we going to do that? Mr. Blade showed you that there's a couple of areas, maintenance itself. So that is something where we have already ticked the boxes, but we're never happy with what we've achieved. So also here, we try to continuously improve, and we try to do things better tomorrow than yesterday or the day before yesterday. But mostly is coming from projects, and we're very transparent about that. You can see that also when it comes to technologies. There are still surprises in execution. So sometimes projects are not run the way we had planned, and sometimes we have not been carefully and commercially driven to complete the project. So we very intensively work on this. It's also about corporate culture, and we here on the board have only been around for a year, and together we are promoting and enhancing this culture to more carefully, more commercially execute plans and projects. And then also it's about the right selection of projects. So it's really about being realistic about a certain gross margin that you can get to having a certain contract. And sometimes you need to be strong enough to say no. And then you say, all right, we leave the field to somebody else because we can't do this and get to the margin we need. And the markets are good. And because of that, we think that we can afford to say no occasionally. And also in 2019, 2020, we have said no to a couple of geographic regions because we considered them to not be profitable. And of course, there is an improvement of the use rate. Of course, it's very important to use people efficiently. Also, of course, having in mind, where can people be best employed in order to also generate the margins we need. Then there's, of course, sales, and there's the SG&A. So a couple of developments were already mentioned. 8% of revenues in 19. You can see very clearly that we had a very nice track record, and now this journey, of course, continues. It's 7.0, 7.6% this year, and then 7.1% in 2021, 7.0. And then we are, of course, expecting more growth. And, of course, we try to remain below this 7%. So these are internal indicators that we now also externally communicate very, very clearly that help us to measure how we are doing and how quickly we get to the numbers we'd like to get to. How are we going to get to overhead reduction? It's really because of increases and efficiencies, and it's really about merging companies. It is really about having fewer units, and it's also about having shared service centers in all the countries where we operate, and that gives us some critical mass, and that is something that we can then build up and build out. And then Oberhausen, Mannheim, and Germany, we have already created shared service centers for Germany. We are doing that in Austria at the moment. We're also doing that in the US and also in Holland. And that is also something that we can do in order to make sure that we have professional people that can work on the transactions professionally, but that also come with the right economies of scale. So that shows you our development of our legal units. We start in 2016. Back then we had 279. Last year we had 160. Again, continuous improvement will go on that way. So we are merging the US-American companies at the moment, also in Holland. So we want to do away with the more complex structures. We want to see efficiency increases, and we just want to make it easier for us to work with ourselves. And this journey continues. I can't really tell you how many legal units we'll have in 2024, but I'll make sure to have as few as possible, because very, very clearly this is very beneficial to us to also reduce overhead. That gives an overview of our IT projects. That is really about the common rollout of SAP in our larger companies to have the same platform, but there's also an HR platform. And HR, we call that Hercules, and that is something that we have completed. So we completed that late 2019, and SAP will go on until Q1 2019. 94%. That is what we're at. So also, since I've been around, we've noticed what the benefit is from having a common ERP system. And now the target is to be done with 94%. So that is what the revenue is going to be on SAP. So the 28%, that is really the build-out. You know, before my time, we had planned for 66%. So now we've seen the benefits of that transparency, collaboration, and because of that, we decided to expand the scope and to enhance to 94%. The remaining 6 are in smaller companies, and it would not be profitable to roll out SAP in these units because they would be too small. But it's not only about efficiency gains, it's also a lot about transparency, it's also about working capital. So it's extremely helpful to now have one ERP system in many of our companies. The rollout can be seen here on the right-hand side. That is by the end of 2019. That is 70%, and now 90% are planned to be done by the end of 2020. And then the remaining will be done in the first quarter of 2021. So the whole process will be put on a very proper foundation for the further collaboration and expansion of Bilfinger. Working capital. That is my favorite chart. Unfortunately, it's something that we are never done with. And I actually like these different things, you know, working capital, going on holiday, and then you can see the traces straight away. So, however, we are in a very, very fortunate situation. So we have very, very good customers. We have very reliable customers. You know, once they receive the invoices, they mostly pay the invoices on time. I've been very grateful for that. I've worked in other sectors where it was totally different. But also, our business is characterized by being work in progress. And that is something that I'm not so happy with, because that is tied capital. So basically, we have to pre-finance our projects, because our people, of course, need to be paid regularly and punctually. But for a lot of projects, we have to get to certain milestones until we are being able to invoice our customers and then be paid by our customers. And this is a couple of DSO, that is the number of days in ratio to revenue. And by the end of 2019, we had a DSO of 74 days, and that includes prepayments. And the business that we're in now, I think, can't see us rest and to have too many of these prepayments. So, you know, in those times when Bilfinger was very strong in construction, and basically they solved that situation by having very, very high down payments, prepayments, and then you did not need to take care of DSO, and that made it all very nice and glossy. So today, this is rather going to be an exception to get prepayments for projects. So we need to take a look at all these different receivables. And basically, it is about being better, about being more efficient when it is about contractual management. So what terms and conditions are we happy to sign? And then it's also about claim management. So it's not that I wait until the end of the project until I solve out the payments that I might still be due later. So it's all about invoicing. It's also about general terms and conditions that I have in contracts and agreements. I have not been with Bilfinger long, but I've been in projects for quite some time. And a lot of project managers think that as long as the system has cash, you give it away too generously. and then you give it away with very, very generous terms of payment. Sometimes we need to give some way when it is about terms of payment, but we also need to understand that also that comes at a price. So we continuously work on improving this situation as well, and I'm also optimistic to make major progress in 2020 and 21, and we will get more cash out of our working capital. And also this aspect will be increased using a certain incentive system for our executive managers. So there is not only that wonderful performance in Q4 as we saw in 2019, but every quarter we'll see some focus on working capital. So it's not going to be about that one deadline, 31st of December only, but we'll take a close look at all the quarters in order to make sure to get the money earlier. Let's now take a look at capital allocation. So what are we then to do with the money that we get from better revenues, better results, better working capital? So what are we going to do? What is our strategy? Today, we are at S&P. When it is about the ratings, we are at BB, so stable. And of course, we are ambitious to bring Bilfinger back to investment grade. Why is that? Mostly because next time, so there's the refinancing in 2019, that is done. But now, next time we are to refinance Bilfinger, I would like to see some investment grade. And that is just to make terms and conditions better, to make it more affordable for funding and financing. And of course, the S&P guidelines need to be pursued. We need to be conservative when it comes to the years to come in order to get down to it. So I talked about the 5% EBITDA, and I also talked about the relevant cash flow generation. Once we've done that, we are back to our investment grade. What are we doing for dividends? For 2019, we suggested to pay a flow dividend. It's €1 per share. But then, as of 2020, our dividend payment is very attractive. It's going to be 40 to 60% of the adjusted net profits. And some people have been saying, well, now Bilfinger is repeating that once they have cash, they actually pursue this very expensive M&A policy. I think we are now in a situation where we can still do with a couple of M&As, not only from the financial point of view, but also in terms of stability. So we can now carefully integrate units. But coming from Switzerland, doing finance means I'm very selective when it comes to M&A targets. So we have a couple of criteria for M&A, and we expect the companies that we take a look at, that we might purchase, that they have an EBITDA contribution within 1 year after integration. We want them to have a ROCE and WACC within 2 years after integration. We want them to be asset light. We don't want to invest too much. And then also we would want to have an attractive ROCE to start with. And also we would like to start integrating those units immediately after takeover. So these criteria will make sure that we are not going into that, carelessly and just, buy as we did in the past. So we very critically are to assess these units. Last, let's take a look at our M&A strategy. I mentioned that we are now sound enough, robust enough in order to manage successful integration once successful targets have been defined. There's certain core geographies that we focus on, areas that we're active in at the moment that allow us to grow, and that not only allow us to grow organically, but that would also allow us to make a leap forward. So it's very, very important to also see some relevant synergies, and that needs to be calculated, and it all needs to be brought home. And of course, these targets need to come with good margins 12%, that is definitely something that we take a close look at. Either they have 12% of operative margins, or we think that we, being new owners, could get to those numbers very quickly. Sources of financing, I mentioned a couple of those, of course. Better results, then also better working capital management in order to have more cash flow ourselves in the years to come. But I think it's also worthwhile mentioning that we are still talking about the 49% share in Apleona, and there are rumors, Ecotec, that is the other 51%. They will try to dispose of Apleona in 2020, and that would, of course, give us more cash for acquisitions. So in our balance sheet, we now have 240 million euros for this share, and we have said a couple of times that we believe this to be a rather conservative value, even if I don't want to speculate. I'm not working with Apleona Digitech, but we consider the 240 million to be rather conservative. So that is the means that are available at the moment for an M&A strategy. And now I would like to turn over again to Tom Blades.
Thank you very much, Mrs. Johansson. I would like to draw a line right here because you've got lots of questions, as I can see. Now, a summary. 246 remains. It was the right choice back then, and it continues to be the right choice. We have slightly changed this. We used to have 4 regions here. Now we write 4 segments: Europe, North America, Middle East, and technologies. What we've also adjusted is the core competencies down here: employees, expertise about the plans, the assets of the customers, and also how we deal with data, that is digitalization. We have shown you what the world looks like to us, what the trends are, and what we can offer here, what our biggest levers are to arrive at a margin of more than 12 for this year. We are at more than 9 and more than 10 for the fourth quarter. And the biggest task remains technologies to bring it up here. And this is something that we want to make us more predictable, more reliable, and more sustainable. Predictable, reliable, sustainable. This is important to us. And if we do all of that, this is what the result will be. This is the targets we've set ourselves for the third horizon. We want to achieve more than 5 billion in 2022. We want to have a sustainable EBITDA of 5%, reported EBITDA of 5%. And our reported EBITDA, as if you take a close look at it, you can see that we write a minimum of 5%. And you know that business is moving, is volatile, but the lowest limit is 5% EBITDA. This would be an ROC of 8 to 10%, a return on capital employed. And as Mrs. Johansson already stressed, we want to generate more than 200 million euros in cash. And in the midterm, this will also lead us to investment grade, BB+, and better is our objective. And the cash will also enable us to have a sustainable dividend payout, which we have already presented in 2017. We want to pay out 40 to 60% of the adjusted group results as a dividend. Now, you know how we view the world, what we think the global drivers are. You know what our core competencies are, where they come from. You have seen our imperatives. All of that makes up our strategy. And we have also illustrated how we want to fill this strategy with resources, our know-how, our employees, our technology. We have also shown you how our customers need us. And I think with this, I can tell you, we are Bilfinger, we make it work. Thank you so much for your attention.